Hey everyone, welcome to Tax and Accounting Tips, short videos designed to get you a bigger tax refund, protect you from loss, or just give you peace of mind that the IRS comes knocking, you've got things right. If there's one thing I've learned after many years in this business, it's that our income tax code is very complex, which causes many taxpayers to fail to claim all their deductions, mistakenly paying more each year than they're required to pay. I really don't want that to be the case with our clients. So if you have a few minutes, I'd like to go over some of the top 10 most commonly missed tax deductions. You may find that some of these deductions apply to your particular situation, and if they do, make sure you speak up, because doing so can help us save you money. So here we go. Number one, did you refinance your home recently? If so, you may deduct the mortgage interest points on your taxes, but you may only deduct a portion of the points each year, with a limit based on the life of the loan. So with a 30-year mortgage, you can deduct 1/30 of the points each year on your taxes. On the other hand, if the points are from a new house purchase as opposed to a refinance, you can deduct the full amount of the points that you paid at purchase time. Number two, if you invested in solar energy between 2008 and 2021, you qualify for a huge tax credit. The renewable energy credit is available for solar energy, solar water heating, geothermal energy, fuel cells, and wind energy improvements. It's worth up to 30% of your qualified expenses with no upper limit on the total credit. However, the credit is phased out to just 22% by the year 2022, so take advantage as early as you can. Number three, student loans. If tests to deduct the interest on student loans are met, the loan is in the student's name, interest can be claimed as a deduction. Unfortunately, the parent isn't eligible to claim the deduction, but you can treat the payment as a gift to the child, and then the child can claim the credit on his or her own return. Tricky. Number four, the earned income tax credit. It's available to many low-income wage earners, whether you earn through an employer or you're self-employed. The income thresholds change each year, so be sure to call us for this year's limits. Number five, small and large business owners love the bonus depreciation deduction. Instead of expensing your asset purchases over the life of the assets, you can elect to expense up to 100% of the cost of those assets immediately when you buy them. Number six, if you're self-employed, then you pay Social Security and Medicare taxes times two, both the employer and the employee deduction tax, as opposed to the W-2 person who just pays the employee portion. That's painful for the self-employed, but they can get some relief by deducting half of the Social Security and Medicare tax on page 1 of their tax return. Number seven, any contributions you make to a qualified charity is eligible as a deduction as long as it meets the IRS criteria. Common deductions include cash, non-cash items, and even mileage for volunteer work. Number eight, for college tuition, the American Opportunity Credit is available for up to 4 years of tax returns for qualified students. 100% of your first $2,000 in qualified school expenses may be claimed as a credit. An additional 25% may be claimed on the next $2,000 in qualified expenses. So the total credit is worth $2,500, and it might be refundable up to $1,000 if the credit is more than the total tax liability for the year on your return. Refundable means that you can get the $1,000 even though you never paid it in the first place. It's like welfare. Now, if you don't qualify for the American Opportunity Credit, you may qualify for the Lifetime Learning Credit instead. This credit is calculated as 20% of the first $10,000 of eligible school expenses. You must be an eligible student at a qualified educational institution to claim the credit, college basically, and unfortunately it's not refundable like the American Opportunity Credit. Number nine, the most commonly missed deductions are actually taxes themselves that you've already paid, such as state and local sales tax and state and local income taxes. You may only claim one or the other, and both are subject to the $10,000 cap. Finally, number 10, did you know that your supplemental health insurance premiums are a medical expense? That's one my father missed years ago until he finally let me, his CPA son, prepare his tax return for him. Well, I hope you got your wheels turning a little bit. And as I said before, the better informed you are, the more I can help you save you money. And just remember, if you have any questions about these deductions and credits, give us a call. Our tax professionals are always happy to offer advice on your personal situation. Thanks, and have a great day.